I want to turn to what it all means here as we are, of course, bracing for that decision, what it means for the markets as investors try and figure out where Jay Powell and the Fed might go from here. For more on that, I want to bring on our next guest. Chester Spatt is professor of finance at Carnegie Mellon University's Tepper School of Business. And Professor, thanks for coming back on here with us. I mean, when we're looking at maybe this decision, obviously the Fed has moved a lot quicker here to quell inflation rising at the fastest rate we've seen in decades. So, I mean, when you look at that, how much of it is maybe just tied to the situation around COVID, and what are you expecting to hear when Jay Powell steps to the mic?
I think I think a lot of the current situation is tied to the past policy response to the COVID. We've had inflationary pressures over the last year to a dramatic degree. We've had pressures on the one hand because of efforts by the government to increase demand, both efforts of the Fed to heighten liquidity and the efforts of the administration in fiscal policy to replace income, and they actually more than replace income over in fact the last two administrations. And at the same time, we've had a lot of incentives for people not to work, to some extent because of the COVID, and to some extent because of the infusions of government resources, which have discouraged people from working. So we have a situation where you have huge demand and reduced supply. So of course we're going to have inflation. I think it's remarkable that it's taken the Fed and the administration so long to recognize it until at the start of the month they coordinated and stopped using the word transitory. But I think I think we face a very serious situation. Unemployment is close to record lows, now at 4.2%, and inflation is the highest that it's been in 39 years at 6.8% on an annualized basis. So we have a huge problem, and I'm glad to see that there's finally some recognition of this. So the Fed is going to appears to be on the heels of reducing its purchases of bonds.
To what extent do you think the Fed's credibility has been hurt as a result?
I think the credibility. Well, I think the credibility has been hurt. I think the use of the word transitory had become a joke over the recent months. Now, I think the feeling at the Fed is that if it engages vigorously in the inflation fight and is able to handle the inflation, then its credibility will be restored. And that's so we'll have to see what happens. Whether 3 rate hikes next year are going to be sufficient. I think this is very much of an open question. But part of the problem within the inflation side, it's in part the loose money policies of the Fed, but I think it's also the broader fiscal policies of the administration. To some extent, I think this was sort of justified at the early stages of the COVID. I mean, at some point, we had unemployment rates of more than 10%. Right now, unemployment is at 4.2%.
Yeah, no,
and we have lots of jobs. Lots of jobs. We have more than 10 million vacancies in the economy.
It's a very good point. I mean, the other thing, too, that we've been hearing from a lot of people talking about inflation and the problems there, maybe louder in the cryptocurrency circles around the dollar and what all this money printing means for the dollar, has not necessarily come to fruition. Now, we are talking about inflation here. The dollar itself has held up pretty strong against global currencies. And as Brian highlighted just a little bit ago, there are key decisions being made by central bankers all across the globe. I mean, when you look into that, and maybe how the dollar, even against the yen, dealing maybe not with the same inflation pressures we're dealing with here, how do you kind of gauge, I guess, in the global context, how the Fed has managed this situation and where they sit, given the fact that the dollar has held up now?
Well, I think the Fed, I think the Fed has been, I think, quite stimulative, and I think this has been true to some extent around the globe. maybe not quite to the same extent. I mean, things started out where interest rates in the U.S. were at higher levels than in other countries. So the Fed had the luxury of being able to allow interest rates to decline further and quickly. It's really, I think, the issues now are not so much about the initial policy response, but in my view, particularly the response over the last year. And just to be clear, dealing with something like the COVID in the context of monetary policy is certainly challenging. We really don't have historic experience with respect to something like that. But I think the imbalance between, on the one hand, pushing demand, and on the other hand, some of the natural restrictions on supply, and then policy-induced restrictions on supply by discouraging people from being willing to work, have really set things back.
Chester Spatt, Carnegie Mellon University Professor of Finance. It's good to have you on the show today. Appreciate the time.